And I'm sure you have plenty of guests who will argue why it has to go to 6,000 or 10,000 or whatever. And I'm not saying they're wrong. It just makes me a little nervous because we had a hockey stick from 2,500 up to 3,000. We waffled a bit, and then we got another hockey stick. So if it hockey sticks again, that's 3 in a row.
Yeah, I mean, look, with spot gold somewhere around $4,000 and spot silver somewhere around $50, people are going, oh, that's too expensive now. No, it's not. It's absolute chump change. That means it still remains severely undervalued to its fundamental value. So those straight up lines, okay, that's when they finally will begin to let go of that pressure on the currencies.
Market analysts Lobo Tiggre and Lynette Zang break down a crucial moment unfolding in the precious metals markets, offering a grounded perspective on why today's prices are not expensive, but still dramatically undervalued. With gold hovering near $4,000 and silver around $50, many investors fear they've missed the opportunity. But according to the latest market action, the vertical hockey stick moves we've seen are not signs of a bubble. They're signs of pressure finally being released from years of currency suppression. The recent series of sharp price surges in gold, fast runs from $2,500 to $3,000 and then higher, point toward a market waking up to the true weakness of fiat currencies. Meanwhile, silver's position near $50 is not a ceiling, but a staging area, with fundamentals still suggesting massive upside ahead. The message is clear. The physical metals revaluation is just beginning, not ending. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now, listen to the interview.
It was concerning me that silver recently was screaming north faster than gold was. But we have a proximal cause for this, the squeeze, the physical squeeze in London, the price to borrow silver in London to meet physical demand, skyrocketed enough to fly some silver from New York back to London, and apparently more of it came from China to help resolve this. But I like this because, silver's kind of reverted to trend. Like it started more than catching up with gold, and now it's reverted to trend. And that's good for the longevity of this market. It's really interesting to me that gold is doing that beach ball thing. Like it's gone under 4,000 and it just keeps coming back up again. And when gold hit almost 4,400, right, and then rolled over and it started going down, it was reasonable to say, where's the floor, right? And a reasonable, at least psychological, if not technical level would have been 4,000. Does it hold 4,000? Because if it kept going down through that, the technical guys would say your next Fibonacci is like 37 and change or something. That would be a significant pullback, or a much bigger one than we've got now. Almost officially a bear market, right? So the fact that it doesn't seem to be going there, that it's catching a bit, that's really telling to me. If this continues, the longer this 4,000 consolidation goes, like if it did the same thing at 3,000, did the same thing at 2,000, and then what happened? It went up to the next big leg up. So the longer this consolidation goes, the more confidence I will have that the next big move will be up, not down. It's gone really high, and maybe it's time to lock in some gains and things. And it's quite different. And this is why I think the beach ball thing with $4,000 gold is so important. Because if it was the nervousness that, this is a nosebleed valuation, it's irrational, it's got to pop and then go into a bust mode, which we could say about other markets today, maybe. If that's the nervousness that we had, I don't think gold would have stopped at 4,000. I think it would have blown through the Fibonacci and easily gone back to 3,000, maybe even lower. That didn't happen, or at least hasn't yet. That's why I say the longer we consolidate here, the less I worry about that. Whereas the nervousness that, this is faster than we expected, clearly that there was a yes there. There were people who were ready to lock in gains the moment it seemed like things rolled over. And by the way, I was one of those.
Fair enough.
And you can hate me if you want, but it wasn't just me. Our good friend Rick Rule, on recent interviews, he's mentioned reaching the point of no concern, as he calls it. And this is actually an important point. It's not like Rick is now bearish on gold and silver, nor am I. And it's not like he's completely out of the markets. He's just sold enough that he has no risk, like he can't lose. I've sold enough that I've actually locked in gains. So I can't, not only can I not lose, I can't not make money. And I've made enough that I actually still have enough left on the table that if the next big move is up, I still make even more money. And by the way, I paid down my mortgage. I mentioned that in terms of keeping things real. I'm not betraying the cause of silver or gold or something. I'm just saying, it went way up. I had a lot of money unrealized. Silver bulls especially, but gold bulls too. When I talk about taking profits, I'm talking about the stocks. I make money speculating on the stocks. Gold and silver bullion, I don't say it. It's basically, unless the house is on fire and I need to cash in on insurance or something like that, I only accumulate. So don't accuse me of betraying the metal here, right? I'm talking about locking in gains on these highly volatile securities, which, as you just said, you know, the metals correct a bit, the stairs up, elevator down absolutely applies to the stocks. And that's why everybody should have a strategy for locking in gains.
In this market update, two seasoned precious metals analysts break down the real forces driving gold and silver's latest moves, and why the current volatility may signal strength, not weakness. Silver's recent surge outpacing gold raised concern, but the underlying cause is now clear: an intense physical squeeze in London. Borrowing costs for silver spiked so sharply that metal had to be flown in from New York and even shipped from China just to meet immediate demand. With that pressure temporarily relieved, silver has now snapped back to its long-term trend, a development that supports the durability of the bull market. Gold is showing its own unmistakable signal. Despite sharp pullbacks, every dip under $4,000 behaves like a beach ball pushed underwater. It snaps right back. This repeated defense of the $4,000 level suggests significant real buying, not speculative froth. Historically, long consolidations at key levels have preceded explosive upside moves, just as they did at $2,000 and $3,000. Some investors are locking in gains on mining stocks, but physical metal remains a long-term accumulation asset as bullish fundamentals stay intact. Let's get into the interview.
And silver over the last 2 years actually did outperform gold in that same time frame. But whether it was spot gold or spot silver, whoa, I mean, the dollar's performance against the Argentinian peso didn't even come close. So are you ready for that shock overnight devaluation? Do you really think that can't possibly happen here? Because we're being warned in the devaluation trade what they're really setting up. Because where are Argentina's gold reserves? Well, my goodness, they gave them and sent them away in September 2024. The Argentine Central Bank attempted to end weeks of rumors that the country's gold reserves had been shipped abroad by announcing that they had successfully completed the transfers of parts of its gold reserve to its various accounts. Did that really do it? Did that calm everybody's nerves? No. Where is that gold? Nobody knows where it is, where it possibly could be. But maybe they needed to do that to appease their creditors and get a $20 billion IMF deal loan. That's what that means. Deal means loan. If they tear down currency controls, because the government's going to try and control everything. They want to stay in power. They want to stay in control. But I want you to pay attention to the date in this, because this was April of 2025. Did that do it? I think not. Because if you also take a look at this, and I wanted to particularly show you the black market for the peso, there's that overnight devaluation that I just showed you. The blue line that's above it, well, that's the black market price. When a currency is dying, there's always a black market that pops up.
In this segment, the discussion turns toward one of the most overlooked warning signs in global finance: sudden currency devaluation. While gold and silver have delivered extraordinary performance over the last 2 years, neither comes close to the catastrophic collapse witnessed in Argentina's peso, a real-time example of how fast a currency can fail. The troubling part isn't the devaluation itself. but the secrecy surrounding Argentina's gold reserves. After announcing in 2024 that large portions of their reserves were transferred abroad, officials insisted everything was normal. Yet no one can say where that gold is, who controls it, or whether it was pledged to secure the country's latest multi-billion-dollar IMF loan. By April 2025, the black market peso rate exposed the truth. Confidence was gone, and the official narrative couldn't hold. History shows that when a currency begins to die, a shadow market always emerges first, and it signals what's coming next. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.